right, we are recording, and so I am going to make sure you all can, just so if you have some questions, I'm gonna try to fly through this and not keep you all long, but I also want to make sure you you can let me clear that. Make sure you all can ask questions when we get to that point. I just want to make sure. I'm looking at here we go. Okay, give me a second and then we'll start working and rolling. Okay, so that's good. All right, so the reason why I wanted to do this and start this video, because I had got a lot of you all asking me, Jason, we need to, we want you to do a class of an investment class for beginners to give us sort of a, what do we need to do? Where do we need to go? If I want to get into investing, what things need to happen? And so part of me doing this class was because that's what my foundation does. You all know that when you watch, I post a lot of stuff about leveling up as far as investing. And it's been 2020 has, if anything, shown us that nothing is promised. And that at some point we all really, if we want to begin to level up, we got to start understanding how do we, in essence, get into this world of investing, making money, leaving inheritance for our kids, financially reaching our goals. And so this class will be one of many that I'm going to do. And this is just the basics to get you all acclimated and into the arena and the world of investing. So as we begin, I have to give you this disclaimer that, the things that I'm going to say here, it's not investment advice. I'm not telling you which stocks to invest in. I'm not advising you on your personal situation. Right now, this is all education. My opinion should not be taken as investment advice for a particular stock or company. You're going to see some things in there. That's not me saying you should go and buy the stuff that I'm going to show you. I'm just using it for education to get you at a level where you can understand some of this stuff. So technically, all these are just for informational purposes only. It's not investment advice. When you want that, you can talk to me offline, talk to some other people offline, and we can get you where you need to go. Looks like I got it. So we're going to go through the why invest. What kind of investor are you? When is the right time? And that may shock some of you. Where do you go? How much do you need to start? That might shock some of you too. We're going to go through a few terms and things that you should know. And then we're going to look at how often do you need to look at your investments. We'll talk about that. And then I'm going to end with some things to think about that I want to show you. If that's cool, you all just give me a yes that you see that. So the first thing I want to talk about is one of the reasons why we invest. One of the reasons why we invest is I want you to look at the United States inflation rate from 1990 to 2020. And so one of the things for all of you who may not know, inflation is basically as time goes on, the value of the dollar decreases. I like to give the example. How many of you, like for me, this was my awakening to inflation. When I was a child, we used to love cereal. I used to love milk. And cereal at one point in time, milk was not expensive. And then one day I remember going to the grocery store and cereal and milk cost like $75. Like that's inflation. That you need now more money to buy and purchase the same items that you did quite some time ago. And so we look at inflation because as time goes on, the value of the dollar decreases. So if you look at this 1.2% in 2020, that's what inflation is. That basically means that your dollar, that let's say $99 is now going to be worth like $100 or $1, to keep the math simple, is now going to be worth like, you know, $99.08, you know. And so the point of that matter is that as inflation increases, the value of your dollar decreases. And so what happens is you need more money to buy the same examples that you used to use. In the investment world, we invest because we want to generate money. And so if inflation is at, let's say, 3.2%, and my investment is giving me, let's say, 6%, and inflation is at 3.2, well, I'm not really making that 6%. I'm actually making I'm actually making 2.8, whatever. Let me see what that is. If my investment is at 6%, meaning I invested in something that I think is going to generate 6% interest, but inflation is at 3.2, then I'm really only making 2.8. You know, well, I'm really only making 2.8%, because inflation, again, as time goes on, the value of my dollar decreases. Whatever I'm investing in, when we start factoring it into inflation, then I'm not making as much. Are you all following that? Give me some yes in the chat room or no if I need to explain it a little bit more. So when we look at the United States inflation rate from 1990 to 2020, one of the reasons why we're investing is because we need to generate wealth. We need to generate higher interest levels. And so that's one of the reasons why we invest in the stock market. We invest in real estate. If real estate is giving us a return on average, let's say 12%, and inflation is at, 1.2 or 1.8, what have you, then we're not being hurt as much. But if inflation is at 1.2 and our investments are only giving us 3%, well, quite honestly, you're not making any money. So one of the reasons why we invest is to make money, generate wealth, do things of that nature. One of the things that I wanted to touch on, everybody, and that is, when we talk about investing, most of you already know why you should invest. I mean, let's be honest. Many of us, and I know many of you, we can give me reasons as to why we know we need to invest. You know you need to invest if you don't have any money saved for retirement. You know if you got a goal and you want to buy a house, you know you need to generate some money. And we've already shown you that just putting money in a savings account that may be giving you 2% interest when inflation is at 1.2, we already know you're not making any money. So we know why we should invest. You know, if you got kids and you want them to go to college, maybe get a trade, if you want to leave some money behind, you know you need to generate some money. So I don't really want to talk about, why we should invest, because I think in this day and age, most of us know why we should invest. So here's the kicker. The issue boils down to, if we know why we should invest, then why aren't we? That's the real issue. And a lot of people have said, well, I don't have enough money to invest. 55% of people think that they don't have enough money to invest. That's false. It used to be back in the day where, because investing was thought of, you had to be rich, you had to have a boatload of money, and all the financial people contributed to this mentality. People like us, the regular Joes, we thought that you had to have $100,000 in order to invest. That's not true. You can literally buy stocks for companies, but with spare change. So the idea that you don't have enough money to invest is a myth. You can invest now with $1, spare change. I don't have enough time to invest. Sure you do. If you have some time where you have free time at any point in the day, you can invest. Nobody is busy 24 hours a day, 365 days a year for 60 minutes an hour. Nobody is busy that much. The third, I don't trust the stock market. That's a rational mindset, a rational excuse, but it's wrong in the sense that if you don't trust it, then why? 9 times out of 10, people may not trust something because they don't understand it. Well, when you understand things, you get more comfortable. It's a reason why you have a lot of people investing in the stock market. It's a reason why you have a lot of people who made money. And so let me clear this up. And I get into this sometimes, even with my wife sometimes. Investing is not gambling. You will hear people say, well, it's like gambling. No, it's actually not. Because with investing, you're actually going off of data. You're actually making intellectual decisions. You're actually looking at the history. You're actually looking at the way a company is run. You're looking at a product. Gambling is done with probabilities. And quite honestly, you feel like you're counting. It's all luck. It's all by chance. Investing is not chance. You can, for the most part, when you get to understanding what you need to look at, you can determine what's a good investment and what's not. And the reason why we say that is because you have millions of people doing it now. The other issues, I'm afraid to lose money. That's because you may be looking at investing as gambling, or you don't understand it. Or better yet, you don't have a game plan. So there's some things to these fears that when you begin to understand, you'll start to see they're really not holding you back. It really boils down to what's your mindset, where are you at in life, and where do you want to be? Now, what kind of investor are you? So the kind of investor you are depends on a number of things. And I don't want you all to listen to your friends, your homeboys, your homegirls, and, convince you that 9 times out of 10, they know what they're talking about. Most people, unless you've been doing this, you may have some kind of idea, but when you really start getting into the world of investing, the kind of investor you are has a lot to do with a lot of things. How old are you? If you're 18, you're going to be a different investor from someone who's 55. Your risk tolerance. If you are afraid to lose money versus somebody who, they want to go big, you're going to invest differently. Your experience, you're going to invest differently. Your time horizon. At 46 and married, my time horizon for reaching my goals and things I want to achieve is way different from a single 24-year-old brother who just now coming out of college. What's my goals? Am I investing for a college fund for children? Am I investing for a house? Am I investing for a car? And so the kind of investor you are depends on a lot of stuff. And your investor profile. And I'm going to go up to style, because I'm going to show you that. Your investor profile is basically all these questions that we ask in the industry to determine what kind of investor you are, and they're questions you should ask yourself. Now, what kind of style do you have? It's a lot of different styles when we talk about investing. Fundamental is a person that they look at who runs the company. Let's say, for example, Nike. A fundamental investor, a style investor is going to look at Nike and go, okay, here's the CEO that runs this company. The company seems to be running pretty good. He's made some money. They have a good management team. They got good products that's coming out every year. They working with some sports figures who will be in the game for a while and have great brand recognition. Fundamental people look at that. Technical investors are different from fundamental. Technical investors will look at the price, the way the stock is moving. A technical investor will look at, okay, at what point in the economy are we at right now? Is this an expansion? Is this a recession? Is it a depression? Are we at a standstill? So a technical investor will look at how is the price of the stock in the economy moving? You all will hear bulls and bears. A bull is a person that they want the stock market to go up. They're banking and they're investing. They're looking for companies where they want to take advantage of the stock market going up. Now, the opposite of that, which you all don't hear a lot about, which goes to this question, do people make money when the stock market goes down? Yes, they do. There's a boatload of people that make money when the stock market goes down. Those people are typically called bears, meaning they're investing when the stock market is going down. They're looking at stocks that they feel will go down, and they're what we call selling short, and I'll cover that in a different class, meaning they're selling the stock short. In essence, let's take Nike, for example. Nike may be at like $120-something. A bear will say, I think Nike is going to go down to $100. So I'm going to sell Nike basically at, $100, but yet I'm going to pocket the difference. So in essence, a bear is saying, Nike is at 120 now. I believe it's going to go to 100. I'm going to sell it based on the fact that it's going to go down, and I'm going to pocket, the difference between where the stock is now and the price I think is going to reach. So that's a much more technical answer, and I'll explain that in another class that I'll do, but that's a bear. Then you have traders. Traders are the people who they bob and weave, you all. They're going into the stock market. They're looking at the price. They're in and out. They may trade on what we call time patterns, an hour, a minute, 5 hours, a day, a week. Traders can be short-term. They can be long-term. Traders are looking to take advantage when the market goes up or down. And then you have the buy and hold people. Those are people like Warren Buffett, who he'll look for something like Coca-Cola and believe that it's going to go up. And so he'll buy it. And if it's a great company, he'll sit and hold it. So you have those kinds of individuals. You all still with me? Give me a yes so I make sure, so I know that you guys are with me. Anybody? All right. Now, I want to show you some things to get you into the kinds of investor that you are. And for this, I'm going to have us all go through this because I want you all to see this. So in order for you to kind of determine or figure out what kind of investor you are, I mentioned to you before that there are some questions that you got to ask. And we're going to go through two scenarios, two quizzes, not quizzes, but two sort of surveys to help you answer those. And I'm going to record this so you all can go back to it. But as you can see here, one of the sites that I wanted to use for this, and most financial firms, brokerage firms, anybody in the financial advising industry, somebody will have some form of this. And this is what we call our due diligence. A fiduciary responsibility from a legal standpoint, the rule is you only make investment recommendations based on suitability. And the way you can find out how suitable, what kind of investor is, most financial firms, even if you're not using a financial advisor, if you're using one of these robo firms like Acorn, Stash, all firms will have some sort of this kind of questionnaire to help determine what kind of investor you are. So, first question, I think I'll start taking funds out from our retirement account. I'm just going to start plugging in the answers. Yep, I'll put the link in the chat. Thanks, Kari. I'll start taking funds from our retirement account. I'm going to click 10, 15 years. Next question. In the next 5 years, my salary will probably, I'm going to say, go up a lot. And again, this is just for information because I want you all to see the process. The next question. When it comes to investing for retirement, here's what I'm looking for. I'm going to say I can handle a high level of volatility for maximum potential and long growth. In essence, what that sentence is saying is I can take on a lot of risks. The next question. Let me just let me scoop this up a little. To make more money on my investments, I'm open to taking a lot of risks with all of my retirement account. Some of y'all may have just been like, yo, that's not, that don't even feel good. The next, if the stock market went down 15%, I would do what? What would you do? And this has a lot to do with what kind of investor you really are. When I'm teaching classes, I like to say, at what point do you start losing sleep? And I'll show you what I mean. If the stock market went down 15%, what would you do? Some people gonna do nothing. Some people will buy more stocks. Most people, because of fear and emotion and not having a solid game plan, will do this. So I'm gonna click this, sell. My statements show that my account has gone down 20% over several months. I'm going to do what? You lose 20%. Keep the math simple. You got $100. Now you wake up one day, you got 80. Some people are going to sell. And so in this example, what it's doing, and this is for the retirement example, this is giving you the kind of investor you are. You are a moderate aggressive person. You are a moderately aggressive portfolio investor. And so based on this recommendation, what they're saying is that 20% of your investment portfolio should be invested in bonds, 52% should be invested in large cap stocks, 16% should be invested in small to medium-sized companies, and then 12% international stocks. Now, if you look at it this way, the further you go down, the more risk you take. International stocks, you will have some exposure. Small and medium-sized companies, these are companies that are not large. They haven't hit like the billions and billions of dollar mark. They're sort of newer, 16%. Most of your money, they're saying you should put over half of that in large cap stocks. Companies like Microsoft, Apple, Coca-Cola, things of that nature. That's if you are a moderately aggressive individual. Oh, okay, let me see. You can't see that screen? Let me go back to it. So based on those questions that we asked, you would be in this kind of portfolio. I believe I'm going to have to stop and share screens to make sure you all can continue to see that. Okay, let me just make sure. All right, can you all see this screen now? Because I got someone that said that they couldn't see it. So can you all see the screen? Okay. So based on those questions, here's the kind of portfolio you would be looking to build. Here's the kind of investor you would be. Now I want to take you through another process, one of these. And I want to make sure I share. All right, you all can see this now? Because I want to go through this so you all can see this. All right, good. Now, what is your investing style? And remember, I told you that there are certain styles, and a lot of companies will have certain questions. I like this one. The one we just went through was more like your 401k retirement. This one is more like as an individual, you as a person, for lack of a better phrase, right? And I'll make sure I'll put all these in our in the section, in our chat section. First question: what do you want from your investments? See, a lot of times we have to make sure that we understand what our goal is. What do you want from your investments? And here's where we begin to answer these questions. What's your goal? Some people, I don't want to lose money, even if it means lower to no gains. I want income now. If you are near retirement, you want to start replacing income, these are the kinds that you would probably click yes. Then you have, I want income now with some potential growth. I'm okay with short-term volatility. I'm going to pick that just for the sake of time. The next question, and I'm not sure why this is 1 year ago, you made $10,000 investment. The value may change over time, over a year. How much gain or loss would you be comfortable with? I'm not sure why this, let me, I just want to go back through that again. It didn't act this way last night or when I went through this earlier. So the maximum gain or loss on an investment is impossible to predict. The ranges shown below will determine your risk tolerance. So let me just click on here. Okay, now I really hate tech because sometimes this stuff happens. This was working it was working fine. So forgive me, you all. It was working fine before we got on here. All right. I did not anticipate. I did not see that coming. Oh, that really sucks. Give me a second, everybody. All right, I'll put the link into the chat session. So let me go back to our So we talked about the risk, and I'll make sure you all have, again, when we get through here, we'll do the talking chat session if you guys have questions. The questions that I wanted to make sure you all understood. So I get these people saying, when is there a right time to invest? I'm going to answer that in a couple of ways. Number one, I'm going to be a jerk and I'm going to answer it this way. If you still broke, you need to invest. If you still got goals, you need to invest. If your family needs money, you need to invest. If your kids need college funds, you need to invest. There is no right or wrong time to invest. I'm going to say that again. There is no right or wrong time to invest. Now, here's why. When you look at a company, the economic cycle, for the most part, it follows this pattern. The expansion, this is when the economy is doing well. 2008 is when we hit here. Then we went into the depression. Then we went into a trough. Trough means we stay at the bottom for a while. And then what happened in 2009, 10? We had the recovery. Then we had the expansion around 2012 to around 2014, 15. Here we are at here, 2016. The last 4 years, COVID-19. We're not quite here yet, but with COVID-19, maybe we'll get there, because the government, businesses, all these places are being impacted. People are losing their jobs. When people are losing their jobs, they're not spending as much money. So the business cycle, the economic cycle goes through this pattern. And there are some people who invest when they're here. And then there are some people, bears, when the market starts to go down, they invest here. So is there a right time to invest, or is there a wrong time to invest? No. There's never a right or wrong time to invest. Now, with that said, there is a right and wrong time, or there is a better time or a not so good time to make particular investments. Is that clear? Am I making you, is that clear? There is no right or wrong time to invest, but there is a right and wrong or more opportune time to invest in certain things. For example, let's take two stocks. You all know Zoom, you all know Coca-Cola, you've heard of them. What I wanted to do was show you that, again, there's no right and wrong time to invest. However, there may be right and wrong or more opportunistic times, and more times where they may not be as good to invest in certain things. There might be a time to invest in real estate versus not. There might be a time to invest in, for this example, I'm going to show you Zoom stock versus Coca-Cola. So let's take Zoom stock. Let's take what we're on now. Is it, and I want to show you all this 1 month time frame, just to keep it simple, to make sure you understand it. So two days ago, when I put this chart together, this is where Zoom closed at, $376 per share. Now, if you look here, if some of you may have to really look at it, on Monday, October 19th, Zoom is at $568 a share. So, had you invested in Zoom, get this, remember when COVID-19 came and we all started using Zoom, Microsoft Teams, everybody was using Zoom. Zoom was having problems. That was around the same time where you started seeing a lot of people over here pushing the price of Zoom up. And so what happens, because we don't typically have a game plan, we don't know what kind of investor we are, we listen to our friends and people who see all this stuff on the news, and they'll say Zoom is where you should be. You go and you buy Zoom here at $568. Then November 10th, Zoom was at $376. So you just lost close to 200 bucks. Now the goal of investing is to buy low and sell high. This is what happens when you don't understand what kind of investor you are. Your emotions, fear, lack of a game plan get the better of most of us. Because we didn't really understand why we were buying Zoom in the first place, we bought it because all the news said Zoom is the next greatest thing. So you got in at the high level. Now you done lost some money, and now most of us like, hey, I don't like this feeling. I'm out. I'm going to sell. Depending on what kind of investor you are. Some people going to sit and not do anything. Some people may buy more shares, depending on what they think is going to happen with Zoom. Now, I'll give you my opinion. Again, it's not investment advice. Around here, the pandemic, all that stuff is hitting everybody. Everybody was starting to use Zoom. We're all at home now. But guess what? Over time, what happened to Zoom's market share? People are started using Skype a little bit more, but not so much. But Google Meets, Microsoft Teams. There are other places that use company sort of meeting communication software. So now everybody's not using Zoom as much as we were in the beginning when Zoom had that bump. Now you got a lot of different software or programs out there, and supply and demand means the more people demand it, the higher the price go. When the supply side takes precedent, meaning more people are not using it, the price goes down. So now you see Zoom at $376 versus a Coca-Cola. A Coca-Cola, which for the record, again, this is my opinion. This is Warren Buffett's opinion. Coca-Cola is a great company. You all should look at my, on my website, I have a class called How to Invest Like Warren Buffett, and it teaches you what makes a company great. Coca-Cola meets those criteria. But if you look the same time frame, Coca-Cola, October 12th, $51. Where's Coca-Cola at now? $53.98. So there's not a right and wrong time to invest, but there may be better times to invest in certain things. There may be a better time to invest in real estate. There may be a better time to invest in certain companies. There may be a better time to invest in bonds versus stock. So I want to make sure we keep the differentiation between the two. In my mind, there's never a right or wrong time to invest. There are, however, more opportunistic times and maybe not so good times to invest in certain things or certain companies. So where can you go? Many of you have seen the mobile platforms, Stash. I didn't want to list all of those because I'm a certified financial education instructor, and I don't want to be accused of promoting one business or another. I know a lot of people, and I'm not trying to get into any trouble doing that kind of stuff. But you can Stash, Acorns, online brokers, TD Ameritrade. You got Charles Schwab now. You have Fidelity. You can go to financial advisors and firms. And in some cases, you can go directly to the company. They used to have these, what we call DRIPs, dividend reinvestment plans, where you could invest directly into the company if you go to the company itself. We Energies used to have something like that where you can go and buy We Energy stock directly from We Energies. Now, some terms you need to know. One of the terms that you're going to hear a lot is PE ratio. And most of the time when people hear PE ratio, they don't really fully understand PE ratio. Whenever you hear stuff like price to this ratio, price to earnings, rule of thumb, gang, is, yeah, you want that number to be low. So I'm going to read this to you. The PE ratio basically is how much money you're paying for $1 of that company's earnings. In other words, if a company is profiting, if their earnings is saying we earn $3 per share, but the stock price is $30, your PE is 10. Basically, you paying $30 for every dollar that you want to earn. You paying $30 for that share. I'm just going to go to make sure you guys didn't have any questions so far. I'm going to click on some terms that I want you to know. And again, I'll put all this into the chat. You can also email it. This will be on my website if you want to review it. But let me go here. Just to be on the safe side, I'm going to stop sharing and then reshare this with you all. One of the things about all this stuff is they have so many cookies and advertisements. But one of the places that you can go, again, for basics, for introduction, and I like this, 62 terms, annualized rate of return. You all know what that means, the rate of return that you're going to get. Now, here's what you should know, the ask price. So whenever you're buying and investing, you'll hear somebody say, what's the bid or the ask price? The ask price, the lowest price an owner is willing to sell an asset such as a stock. The ask price is what you will buy it for. The ask price is what you are buying the stock for. as compared to the bid price, that's if you're selling it, that's what you're going to be selling it for. So to keep it simple, the ask is what you're going to buy it for. The price is what you are going to sell it at. Sometimes it gets confusing, but just remember, the ask is what you're going to buy it for. The bid is what they're going to sell it, what you're going to sell it for. And then I wanted to give you all just a place where you can have an introductory to some words. Again, you don't have to get super sexy with this stuff, but just so you have it. Bull market, as you said, bulls, people that want the stock market to go up. So when we hear phrases like it's a bull market, means stock prices are rising, people are feeling good about it. They think stock prices are going to go higher. So that's what you hear when you hear the phrase bull market. As compared to or in contrast with a bear market, it's going down. Bear market, the stock prices are falling. Now remember, people can make money whether the stock market is going up or down. That's where you get those bulls versus bear terms from. Now, I want to show you another one, and then we'll move on. Investment terms and definitions you should know. Again, these are more, there's some different words here. Asset allocation. The asset allocation is, remember when the first, what kind of investor are you? We showed you that portfolio. That's what asset allocation is. How your portfolio should be distributed. How your portfolio should be broken up. Meaning 52% in large cap stocks. That's what asset allocation is. The different assets, how they relate, perform to each other. International stocks compared to American stocks, compared to bonds, compared to just cash. So whenever you see asset allocation, it basically means how is your portfolio broken up? And so this is a good place, again, if you can deal with all the cookies. A few more words. You'll hear capital gain and loss. I'm going to stay on this for a quick second because this is something you all should hear. It's technically, let's say I bought a stock for $50, and let's say the value of that stock went down $20. So now that $50 stock that I invested in, it's worth $30 now because it went down $20. If I haven't sold it, technically I haven't lost any money. I'll say that again. As long as I haven't sold it at 30, then I haven't lost it. What triggers a loss or a gain is when you've sold it. So if I bought a $50 stock and it went up to $100, yeah, right now I've made $50, but I've only realized the gain once I sold it. So when you start hearing things like capital gain or loss, that usually implies what did you buy it at and what did you sell it at. If you sold it for a profit, then you had a capital gain. If you bought it for $50, it went down $20 and you sold it at $30, you had a capital loss. So your loss or gain is only realized or activated after you sell it, or in certain cases buy it back. Was that clear? Everybody follow that? Give me a yes or no. Good. Okay. Now, we're ending up here. one of the things that you all need to understand is what we call the investment pyramid. These at the bottom are what we call your less risky investments. Checking and savings accounts, treasury securities, life insurance, cash value, bonds, certificates of deposit. But remember, inflation. Inflation eats up into these kind of fast because we see that inflation in 2020 was 1.2. If these are only paying you 1% or 2%, then technically speaking, you're not really making any money. Now, as you get up here and let's say they're paying you 4 or 5%, fixed income securities, money market accounts, high grade corporate bonds, let's say they're paying you 3 or 4%. Again, if inflation is at 1.2, then you taking a hit. Now we start to get into balanced mutual funds, high grade stocks, where over time the stock market is giving a return of 9.7% over, I want to say maybe the last 90 years or so. And so if you're shooting for a 9% return, well, if inflation is at 1%, then that means I'm realizing 8% return. Then the higher you go, you start getting to speculative common stocks. Penny stocks are up here. All for the record, all penny stocks are not worth a penny. Typically, it's usually stocks that have been just, they're new. They haven't gotten big yet. The typical dollar price may not be higher than $10 a share. They are riskier. People like it because they believe that, it doesn't cost a lot of money, and I'm hoping that I'll hit a home run. What you need to understand about the investment pyramid is this. The higher you go, yes, the more money you can make, but also the more money you could lose. Most people are focused on the more money I can make, not understanding what kind of investor they are, what style they are. And some people end up saying, I want to be up here, but realistically, your heart, your budget, your checkbook, you right here. And so you really need to understand what kind of investor are you, because if you're not up here, you're going to have a lot of heartaches. Next, final slide, I believe this is. Something to think about. So I get this question. People say, well, where should I start? This is something I wanted you all to know because I don't think this gets enough credit. There are 11 companies that control everything that we buy. I'm going to say that again. There are 11 companies that control everything that we buy. Coca-Cola, Procter & Gamble, Nestle, Kraft Heinz, Johnson & Johnson, Mondelez, General Mills, Mars, Kellogg's, and PepsiCo. These are all the brands and products. So when you see all these things, maybe you should start there. Most people think investing needs to be super sexy. It doesn't. Start with start with the things that you use. Start with some stuff that's not sexy, meaning, everybody's not talking about it. And keep this in mind. I mean, I really want you to think about it. 11 companies that control everything that we buy. From the food to the things we drink, to toilet paper, to lotions. These 11 companies own all that stuff. 11. So that is the presentation. I believe I'm going to make sure you all can talk now if you got questions. You guys let me know if you have some questions. I'm just going to hit allow to talk for all of you all. Give me a second. And that way I can answer your questions. I see some people that glad you all are on here. I'm going to just open it up And if I don't get you, just shoot me a chat or something or question. And while you're doing that, I'm going to post those things in the chat box, or y'all can. And
I
better
can.
yet, it'll probably be easier if you just took down my email address,
Okay.
and that way, if you email me, I can email this to you as well as the links that I use. So, any questions so far?
Jason.
Yes.
Hey, this is Ashanti.
What's up, Mr. Councilman?
Everything is well. Great presentation. I think this laid the foundation for people to understand. And even for me personally,
Yeah.
I think it would be helpful if you gave some insight on the different types of platforms that people could get into investing, and the difference between the two, or the difference between the different platforms. You know, just using a 401k or using some of these apps that are out here, and like what the difference could mean for them as an investor.
Okay. That's a good question. And if you guys are not talking, put yourself on mute so everybody else can hear. Yep, I did put my email in the chat. Can you all see that? I'll put that in. I'm going to answer that question, Ashanti.
Did you put it in the chat or did you put it in the Q&A?
I'm putting it in the chat now. Oh, wait a second. Let me, yeah, do y'all see it? Okay. Here we go. Sorry about that. Here we go. Okay. What I'm going to do is, let me see if because I'm glad you asked that question. Did you all get the email address? Okay. Great question, Ashanti. Let me, I'm going to go here. So there are sites like Acorns, Stash. I want to see if I can show you some of them, because they're all financial sites for the most part have sort of the same kind of dynamics, right? They'll all, for the most part, ask you, you know, what's your risk tolerance? What kind of investor you are? Where the difference comes into play is their fees. What do they charge you? What kind of services are they providing? You know, how often can you know, what kind of, do they do dollar shares? Do they just do mutual funds? So let me see if I can show you. Yes, I'm going to make sure you all get a copy of this. You can go to, when I post it, let me see if I can show you all some of the differences in sites so you can just see them, because that's a great question, Ashanti. What do some of them look like? Now I'm going to show you all some of these. You all can see this? All right, so some of the what we call Robo Advisors, you have Wealthfront, Betterment. Betterment is good. I see Alicia on here, my partner in crime. We like Betterment. Betterment is fine. When you go to any of these, they'll basically ask you to you can open up an account. You know, they have things from education, things on saving, investing, IRA and 401ks. I'm just going to click on the IRA 401k, see what that looks like. And most of these, you have some kind of mobile app or mobile device for it. Most of you know, you can see it. Again, they'll have you open up an account. You can do stuff for if you have a business or 401k. My issue with Betterment, they're really good. They just don't offer fractional shares in certain investments that I personally like. All these places are decent places though. Let me go to E-Trade. Many of you may have heard of E-Trade. Again, I'm not telling you to use any of these. I think you have to really look and find what's best for you. You all can see this, right? I got to make sure I don't have to keep stop sharing, and I can just float in between these screens. So E-Trade, account types. Again, most firms will have something like this, where it's a regular brokerage account, whether it's an IRA, they have small business retirement accounts. Let me just look on E-Trade brokerage. And it's the same thing. You can open up a brokerage account, a Coverdale ESA, education savings account, a custodial account if you have kids and maybe they may be young, they haven't reached, I want to say 18 or 20. You can open up account. Typically it's called a Uniform Transfer to Minors Act or Uniform Gift to Minors Act. The issue, most of these companies will sell the same stuff, right? In finance, this is one of my personal favorites. I actually use these guys. Because I build portfolios, I love the work. So these are all great companies. I don't necessarily have a preference. So when you're looking at these, all of them will, for the most part, you'll see the differences are here. I was going to say Wealthfront, I guess you have to have an account minimum of $500. You scroll down, interactive brokers, interactive advisors, you have to have an account minimum of $100. I'm going to put this link into the chat as well. Betterment, an account minimum of $10. Personal Capital. Now, Personal Capital is not necessarily a brokerage company. They do a lot of different stuff. So, but as you can see, $100,000 here at M1 Finance. At M1 Finance, you can open up the account with $100. And so those are some of the differences. Did you all get a chance to see those?
Yeah, we saw.
Other questions? So once you figure out what kind of investor you are, typically it's what do you want to do? And that's how you determine, you know, what where you want to go, what firm you want to use. One of the issues that I talked about was how often do you look at it? I always tell people don't get into the habit of looking at this stuff every day, because you unless you're like a trader, where you're bobbing and weaving, you're going in and you're buying, then you're selling right away. Unless that's you, if you have a buy and hold where you have a goal, then you may want to review it periodically. But don't get to a point where every day you're waking up checking your brokerage account. Because what'll happen is when things don't go well, if you don't have a game plan, your emotions will get the best of you. There's a phrase that we say in the brokerage industry, pigs get killed, hogs get slaughtered. What I mean by that is, so I was doing some trading because I do trading too. I had sat down, I turned $100 into $700 in like an hour. My game plan was to stop. What do you all think I did? I didn't stop. I saw that I turned $100 to $700. Greed took over, and I'm like, I'm about to go up. Guess what happened? I lost all of it. No game plan, or I didn't stick to my game plan, got greedy, and really didn't have a goal. So when we talk about investing, you really want to have a goal, and you really want to understand what kind of investor you are. And when I say investor, I mean, what kind of risk do you want to take? Any other questions? I'm going to give you all this because I think I kept you all for an hour. If any questions, shoot me something. I want to show you this real quickly, then I will let you all go. Give me a second. All right. So one of the issues, and this is one of the financial firms or Robo Advisors I talked about, Ashanti, Acorns. This is their stock price. I want to say as of today, they were at $20.51. I want to show you all when we talk about investing. And remember, we talked about PE, and I said, the lower the PE, the better. But the PE, again, is only for judging similar companies. So if you look at the PE for Acorns, which is like a financial firm, and then you look at the PE for Zoom, you see it's $547. This is why I say you need to be careful when people just start saying, well, they need to have a low PE. Well, based on what and compared to what? You cannot compare technology companies to financial companies. You can't compare financial companies to retail type companies or oil companies. They're totally different industries. And so their average and their normals for what a PE should be is different. In the technology sector, PEs tend to be very high. So when you hear people just say, well, they got a low PE, okay, what does that mean? And compared to what? When you're looking at PEs, you want to make sure you are comparing similar companies. Let me go. You want to make sure you are comparing similar companies. Sorry about that. Coca-Cola, PE is around $27.49, meaning, what did we say PEs was? You are willing to pay $27 per share for every share earnings. Now let's look at Pepsi stock. Now mind you, Coca-Cola's just at 53, PepsiCo is at 143. Their PE is at 28. So if you're looking at these, they got the same, near the same PE, but yet people are willing to pay $143 for Pepsi, for a earning share for Pepsi, but yet for Coca-Cola, you're paying $53. Same PE, almost the same PE, very low, but what's the benefit? You can buy 2 shares of Coke for 1 share of Pepsi. So that's how you start looking at these things when it comes to PE. The market, you know, and I'll get into some of these numbers. I'll do another class on that, but I wanted to just show you the reality of that. Did that all make sense to everybody?
Hey, Jason.
Yep.
So for the next class or session, would you be willing to like break down like the difference between like energy companies and say, for instance, just like you just did with Pepsi and Coca-Cola, like some of those 11 companies, like say, like we can just do like a comparison piece so that we could just at least start to play around with that and see, you know, the differences and how we should, you know, at least try to even think about exploring those opportunities with those companies.
Yeah, the next one I'll do that, and I have a class like that, but I'm glad you said it because I'll redo it, and it's basically called how to invest like Warren Buffett. And when I talk about this stuff, it's really simple. When you guys think of investing, I want you to just keep in mind 2 things. There are great companies, and then there's everything else. There are great companies, and then it's everything else. And when you have that approach, there are certain things that you are looking at. If you guys have time, I'll walk you through it very quickly, but then I'll show you what I mean by that. Let me give me a second. I'll show you right now, and because that's a great question. So one of the things I said was there are great companies and there are everything else. This will be one of my classes. I'll go into detail again with a class because again, I don't want to keep you all too long, but I'll show you what I mean. So first off, there are characteristics of a great company. Number 1, a great company got to be simple. Number 2, a great company has to have great brand recognition. Number 3, a great company has to have products and services that'll never go out of style. And these are the characteristics. And then number 4, a great company has to have pricing power or staying power. So those are some of the characteristics of a great company. It got to be simple. You got to understand it. They have to make a product and services that'll never go out of style. They have to have pricing power, you know, and great brand recognition. Those are the characteristics. So now once we get to the characteristics, can you all see this just to make sure you can see this? Once we get into the characteristics of a great company, then there are rules that I'm looking for when I want to determine whether or not a company is great or if it's just like everything else. So the first rule that I want to look at when I'm evaluating a company, whether it's great or whether it's just like everything else, is I want to see here, give me a second. I want to see here a smooth upwards trend in earnings per share. So if you guys look in Coca-Cola, you all can see that. You see 0.98, 0.103, 0.109, 0.19, 0.129, 0.2008. What happened in 2008? Recession. 2009, 147, 2010, 175. So even in the middle of a recession, the earnings for Coca-Cola didn't get hit, didn't get clobbered. Now think about that. This is in the middle of a recession. That means in the middle of a recession, everybody named Mama was still drinking Coke. So, okay, you're only seeing the Google screen. All right, let me make sure. All right, are you seeing it now? Okay, good. So the first thing I said, after we look at the characteristics of a great company, now we want to look at the rules. We want to look at numbers. And here's where we start to separate ourselves from everybody who's just talking. The first thing I want to look at is the earnings per share, and I want to see that it has a smooth upward trend. So I'm going to go to earnings per share, and then I want to see that there's a smooth upward trend. And I'm going back into 2003, 0.98, 0.103, 0.109, 0.119. In 2008, there was a recession. 2009, 1.47. So as I was saying, that even in a recession, Coca-Cola didn't get clobbered. The second rule that I want to look at is I want to second thing I want to look at is I want to go down to the return on shareholder equity. That's here. And the number I'm looking for return on shareholder equity, I'm looking for 20% or above. I'm looking for return on shareholder equity. The number I'm looking for is 20% or above. And when I go back here, this is Coca-Cola, 27.5, 26, 28, 27. At no point in time am I under 20. Now remember, these are the numbers that will let me know whether this is a great company or whether it's just like everything else. So 2 of the rules have been met. Number 1, a smooth upwards trend in earnings per share. Number 2, I'm looking for return on shareholder equity. I'm looking for 20% at least or above. The third rule, the financial rule, is I'm looking for return on total capital, which is right above shareholder equity. I'm looking for 15% or above. 15% or above. 23, 18, 20, 19, 18, 16, 15. So at no point in time have I hit below 15. So rule number 3 in the financials, I meet that. Rule number 4, I have to be able to, I want to make sure I do this right. The company needs to be able to be in a position to pay off their long-term debt over 4 years. They have to be able to pay off their long-term debt over 4 years with their net profits. So my net profits here, net profit right here, that's $11,930,000,000. My long-term debt is right here, that's $30 billion. So in 4 years, I want to be able to pay off this 30. If you multiply 11 times 4, that gives me 44. Am I able to pay that off? Yes. My long-term debt, I want to be able to pay off over a 4-year period using my net profits. My net profit, 11 billion. My long-term debt, 30 billion. 11 times 4 is 44. Yes, I can pay that off in 4 years. My last rule, my financial rule, is I want to see a smooth, do they pay dividends? Do they consistently pay dividends? Here that is. So, based on this, is Coca-Cola a great company or is Coca-Cola just like everything else? You all chime in. Is Coca-Cola a great company, or is it just like everything else? Great company. That's right. Great. Now, let me show you, not that it's not a good company, but it may not be great. So, make sure you all can see this. Give me a second. We just looked at Coca-Cola. Now we're going to look at Home Depot. Again, I want to make sure you all can see this, so let me know you can see this. And remember, I told you that every company is either, there are only two choices, either a great company or it's like everything else. We understand the characteristics of a potentially great company. Got to be simple. You got to know what they do. They got to have great brand recognition. They got to have pricing power. You know, so those are all characteristics of a great company. Once we see that this meets the criteria of a great company, now it's time to do a little bit of research and back that up. And here's where we separate ourselves from everybody else that's just talking crazy. The rules. Rule number one, and I'll do a class like this, smooth upward trend. That's what we're looking for. Smooth upward trend. Earnings per share. 188, 2.26, 2.72, 2.27, 1.78, 166, 2.03. Not necessarily bad. Compared to Coca-Cola, different companies, but when you looked at Coca-Cola, it was smooth, right? I mean, this is not bad. You know, again, in 2008, we had the recession, 1.78, 2009, 166. You see this. Now let's start looking at some other numbers. We go to return on shareholder equity. The number I'm looking for, remember, was anything 20% and up on shareholder equity. This is Home Depot. I'm looking for 20% and up consistently. 14.5, 17, 21, 26, 43, 65. Red flag. Why am I jumping from 65 to 108 to 183 now to 607? That's just not a consistent flow. This NMF, again, for the most part, means it wasn't a number that was worth mentioning, right? And so when I'm looking at this, am I consistently over 20%? No. Next rule I'm looking at, return on shareholder capital, right above. The number I'm looking for is 15% minimum. I'm at 11, 13, 14, 18. So far, out of the three of the rules, two of them I haven't met yet. Now, for my long-term debt and capital, my long-term debt is 27 billion. My net profit is 13. Yes, I can pay that off in 4 years. And then do I meet the, is it paying dividends? You can see that it is. But think about this. 3 out of my 5 rules I don't meet. And so if that's the case, then is Home Depot a great company? Not based on the Warren Buffett model. Doesn't mean Home Depot isn't a good company, but Home Depot is one of those companies, you all, that come on. Home Depot is one of those companies that are affected by a business cycle. Think about it. When it's a recession or depression, who doing home repairs? See what I'm saying? So unlike a Coca-Cola, which what we saw was even in the middle of a recession and depression, people still drinking Coke. People are still drinking Coca-Cola. So did you all see that? So I'm going to, if you all have any more questions, let me hear them, let me have them. Other than that, I'll post this. You can all email me. I'll put my email address in. I'll shoot you this when I convert it to a video. It'll be on my website. And then I'll also let you all know when we do the next class as well. Hopefully you all, you learned something and you felt good a little, you got a little bit further to your investing. Talisha, how far back do you go? Ashanti said Home Depot or no? Yeah, I'm not giving you investment advice, Councilman. Again, I've always said I don't think there's a bad time to invest. It just depends on what you invest in. I don't have Home Depot in my portfolio as of yet. I'll answer it like that. With Value Line, I try to go back about, it'll go back as far. Now that Value Line, it won't cover all the stocks. So you want to try to go back as far as you can, because that's the more information, the better. Now, sometimes you won't be able to do that, but you want to go back as far as possible. Yahoo Finance, all those sites are okay. One thing to remember is a lot of those places are journalism, like it's entertainment. Nothing wrong with that, but I'd be mindful of, the reason why I say that is, this. You all can see this. Let me know you all can see this. The reason why I say, we have to be somewhat mindful of those sites. They're fine, but again, remember, some of that stuff is entertainment and journalism. So when you go to them, I just want you to look at some of the headlines. This is a day ago. Here's why Zoom video stock is climbing. Why Zoom stock rose today. Zoom's boom may be over. This was all yesterday. So depending on where you're going, you're getting a lot of journalism. They're not necessarily telling you whether they're good stocks or not. They're just, it's journalism stuff. And so I think, it's okay to, if you're looking at the information, I'd be mindful of just seeing something on one of those sites and then just running with it as investment advice. Because as I just showed you, a day ago, depending on where you go, they might have, they have 2 or 3 different views on whether it's good, bad, or what have you. That's why I try to teach people the Warren Buffett, look at the numbers, understand, look at those characteristics, understand the cycle. Should you be looking at these things? Any other questions before we close shop? right. If not, you all email me. I'll make sure you get that information. I'll post when I do another class. I'm thinking me and Alicia Stingley gonna do another class. Alicia, you all, if you haven't, you can follow Alicia on Facebook. Alicia's one of my partners in this game and does very good work. And so thank you. I appreciate that. We'll do some more detailed stuff when we get to the next class. But hopefully this was a good intro for you all as to where to go. You should be investing. There's no bad or good time to invest. There's only bad and good times to invest in certain things or certain companies. And should you be investing? The answer to that is yes. When should you start? Yesterday. Should you look at your portfolio? Not every day. All right, everybody. Appreciate it. Love y'all. Thanks for being with me for an hour, 26 minutes. I'll make sure you all get the next time I do a class. And we'll keep going. Appreciate it, everybody. See y'all in a few weeks.
Thanks, partner.
All right.